let's actually talk about what's happening in the economy. And something big is about to happen. According to the latest ADP report, we're seeing the largest job losses in over 2.5 years. And those job losses are putting the Fed in a really tough position. Now, if you've been hearing that the Fed is going to cut rates again, then you're like, why? Like, isn't that going to cause inflation? Well, it doesn't matter because the job market, it's slowing down and it's going to force their hand. So here's the situation. The government conveniently shut down right before the BLS released the latest statistics on job losses and job gains. And so because it didn't report, the bond market is reacting to the ADP report, which showed massive job losses. And that private data isn't manipulated by some kind of political motive. It's actually true data. So for September, the ADP report showed 32,000 job declines. That's the sharpest drop since we've seen in early 2023. Let's take a zoom out to like a bigger picture. Now, another source, the Challenger Gary and Christmas report, says that so far this year, companies have announced roughly 946,000 job cuts. And that's about 55% more than the same period last year and the highest year to date since 2020. And according to that same report, the total announced cuts are very likely to pass a million job losses before the end of the year. Historically, numbers that high only showed up during recessions and major like shifts in technology or other services. And when numbers like that come out, everyone's trying to figure out what's actually going on. And this is tough because actually the stock market is performing better than it ever has. So it's completely different. And so what's really causing these layoffs? Let me know in the comments if you think the economy is really slowing down or is it something bigger? What all my Democrat friends are going to say is that it's artificial intelligence taking jobs. It's not. AI is actually giving more jobs right now because companies are focused on innovation. And so even though it's a net positive, and while it did take some jobs, it only took about 17,000 jobs. That's less than 2% of the total job losses we've seen. So, like, what is actually the biggest driver? It's not tariffs, it's a slowing economy. Companies are restructuring, they're cutting costs, they're dealing with weaker demand. It's all the classic signs of a slowdown and the beginnings of a recession. Now, what does this all mean? Well, how does this all tie to the Fed? When the economy slows and job losses rise and openings across the workforce start to shrink, the Fed sees a slowing and cooling economy. So they have to respond. They have to make moves. And so, how do they make moves? They cut interest rates because that's supposed to stimulate growth. The Fed already cut rates in September, and they're expecting to do two more this year and six more next year. But it might be a little too late because job losses are hitting all time highs, spending is slowing. And so, what the Fed has to do is make borrowing cheaper in order to be able to turn the wheels of the economy. Let's look at like 2022. There was roughly 2 job openings for every 1 unemployed worker. So that means if you were looking for a job, like you literally walk outside and there's 2 people offering you a job. But now it's flipped. Now there's actually more unemployed people than there are job openings. And the companies have the leverage right now. It's not as easy for you to go unemployed and then go get a better job. And so because the Fed is seeing that, they're going to have to cut rates in order to be able to avoid a recession. So here's why this matters to you. When the job market cools, the Fed cuts rates. And that has a ripple effect on everything. The lower the rates, the lower the mortgages, the lower the car loans, the lower the credit cards, the lower the HELOCs. But that means there's something deeper going on. The economy's struggling. So, hey, if you're thinking about buying a home, investing, or just trying to understand the headlines that you're seeing on Fox News or CNN, I would pay close attention to the job data because that's what's going to really signal how the Fed is going to behave and what kind of market moves they're going to be making. Bottom line, the Fed's not going to cut rates if things are doing great. If the economy's booming, they're going to leave it alone. They only cut because something they see is breaking or inflation is below 2%. So we're seeing layoffs start to climb, job openings are at a decline, and job stayers are on an increase, meaning people who are at their job are staying at their job and they're not leaving their job because there's not as many opportunities. So when you hear the headlines that the rates are going to start to come down because you follow my TikTok, now you know why. It's not coming from a position of strength, but it's coming from a position of concern. When the official jobs reports and the BLS is finally allowed to report, I'm going to make another video breaking that down. But if you see a weak jobs number, you're going to see the 10-year drop so fast. And that's going to mean that the economy's slowing and the Fed is going to have to cut rates. And so if you want more updates and you want an update on what happens when the government finally opens, make sure you follow, subscribe, and comment any new topics that you want us to address.